the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares dipped amid a tepid day in the region. So if you look at the Straits Times Index, it was down 0.21% at 4,281 points at about 11:51 a.m. Singapore time, and that's with a value turnover of some 584 million Sing dollars seen in the broader market. Now, let's take you through the closing numbers. The STI ended 0.39% in the red at 4,273 points. In terms of value turnover, that's 1.46 billion Sing dollars. Gainers trailed losers 264 versus 280. Top advances for today, we've got for Union Incorporation USD, Mandarin Oriental USD, and SIA Engineering. And top decliners, we've got here GMH USD, Hong Kong Land USD, and SGX. Now, in terms of counters to watch, we do have OCBC because the bank said yesterday that its current Group Chief Credit Officer for Wholesale, Carina Lee, will be its new Chief Risk Officer from 2026. Now, elsewhere, from how Chery Automobile rocketed more than 13% on its trading debut in Hong Kong to how the White House Budget Office is telling federal agencies to prepare plans for mass firings during a possible government shutdown, we've got more corporate and international headlines in focus. And joining me on the line today is David Chow, Director of Azure Capital. David, welcome back.
Hey, hi, Tian. Hi, everyone. Happy Thursday.
Happy Thursday. And let's start with the Singapore stock market as usual. How did the STI fare today and any surprises?
I think with what happened overnight in the US, where the key indices were down, Asia market, were really affected by it. And so it closed in the mix today with the North Asian markets like, Hong Kong, China closing on a positive note, while markets like Taiwan, South Korea, as well as some, Southeast Asian markets like Indo and, Phils, closed in the reds. And our STI was caught in a crossfire, and unfortunately, it closed 0.4% lower, which fell below its 10-day moving average and is approaching the 50-day moving average. So for that, I think it's consolidating on the slight negative bias at the moment. So in terms of surprises, I would say on the loser side, some of the mid-cap favorites like newly IPO Lump Sum Creations and investors' favorite like LHN and Sunday Environment are seeing a bit of profit taking, which is still considered normal given that STI is taking a breather now.
Going to the counters to watch for today, David, we do have OCBC. The bank said that its current Group Chief Credit Officer for Wholesale will be its new Chief Risk Officer from next year. We also have a new CEO at Fraser and Neave. How would you read into the various leadership renewal moves by the companies?
I think that's a clear sign of strong internal succession planning, grooming leaders from within and, making sure institutional knowledge and culture are actually preserved, With OCBC expanding into North Asia and, ASEAN wholesale lending, putting someone with deep credit risk at the helm of risk oversight, I think it's prudent. It's both prudent and forward-looking. I think it will also be signals that growth will not come at the expense of balance sheet discipline. So over at F&N, I think where a new CEO is appointed, this again marks a fresh chapter for consumer and industrial conglomerates. Investors, I guess, will be watching closely to see how capital allocation priorities shift, whether there's a sharper focus on core businesses or even efforts to unlock value from a diversified portfolio. Leadership changes in companies like F&N, I think, matter because they can redefine growth strategy and give investors a fresh narrative, hopefully. So taken together, I think this move really reflect a broader trend in Singapore's corporate landscape, structured succession planning, governance, renewal, to build, resilience for the long run.
Let's go on to Singtel because Singtel's Australian subsidiary Optus was fined 100 million Aussie dollars yesterday for selling phones and contracts to disadvantaged customers or consumers. How would you read into the development and what are the implications for Singtel in this regard?
I think this is one of the largest penalties, if not the largest, ever imposed in Australia's telecom sector, and it comes on top of reputational challenges that Optus has already faced, from past network and data breaches. For Singtel in particular, I think that while the immediate financial hit from the fine is not material relative to these group's earnings, the reputational cost is somewhat more significant. I guess investors will be concerned about the long-term impact on consumer trust in Optus, especially as competition in the Australian telecom market remains intense. So beyond the monetary vanity, I think this also raises questions about internal controls, your compliance framework, and the culture of sales practice within Optus. So, as I was saying, while the fine itself may not derail Singtel Financial, the real story is about reputational recovery and how well management can reassure both regulators and investors that such mishaps won't repeat.
I see. And across the region, David, we talked about this earlier as well, how China's biggest car exporter, Chery Automobile, rocketed more than 13% on its trading debut in Hong Kong, having raised about $1.2 billion USD in its IPO. How would you read into Chery Automobile's first day performance?
I think the Hong Kong's IPO market, as we all know, has certainly seen a very sharp rebound this year. I think in the first half alone, 42 IPOs raised a collective amount of about 100 billion, which marks a 700% year-on-year increase in proceeds and I think a 40% year-on-year rise in deal count. I think, in fact, if I look at the pipeline now, I think it's still deep over 200 active listing applicants by mid-year. Many of them potential A and H shares dual listing candidates. Therefore, it's a very strong showing for the market. So when a hot IPO market occurs, sometimes it may lead to investors buying subscriptions, IPO subscription indiscriminately. But I think on this occasion, some investors of this IPO could perhaps be gunning for quality here. After all, Chery has overtaken many of its peers to become the country's top car exporters, with sales actually surging in Latin America, the Middle East, and increasingly in Europe. And this overseas success, I think, the key part of why investors are rewarding the stock price. It shows the company is perhaps less dependent on China's crowded domestic auto market, where price wars and heavy subsidies have eroded margins. And if you look at from another perspective, there's also the thematic angle. Some global investors will want exposure to the electric vehicle supply chain, but they're selective. They want names with both scale and credible international growth stories. So on that note, the company actually fits that bill, and I guess that helps to explain the strong debut on the stock exchange.
Meanwhile, David, let's take a look at what's going on in Japan. We do have the release of July meeting minutes by the Bank of Japan. So apparently board members, some of them have called for resuming interest rate hikes in the future at the July policy meeting, even as the board decided to unanimously keep borrowing costs steady. So what are you expecting when it comes down to the BOJ's next move? What implications would this then have on the Japanese yen?
I think to me, this shows that an internal debate is starting to surface, whether the BOJ should continue its ultra-gradual approach or move more decisively to really normalize policy. I think looking ahead, I think the most likely path is that the BOJ will remain cautious. Inflation in Japan, after all, has come out its peak, but it's still hovering around the 2% mark, and wage growth, while improving, isn't yet, I think, strong enough to give the BOJ full confidence in sustained price momentum. So Governor Ueda has made it clear that policy changes will be data dependent, and the central bank will want to avoid stopping or even continuing Japan's fragile recovery. So with that being said, now we're looking at global central banks like the Fed now tilting towards easing, and this tends to put BOJ in a tricky spot. If it hikes too soon, it risks destabilizing on domestic demand, but if it holds for too long, it risks the yen sliding further, and hence rising on import costs and potentially eroding household spending power. So the takeaway is this: I think the BOJ is still inching towards normalization, but it's going to do so in a very slow and deliberate fashion. So for investors, this means the yen's direction will hinge on how credible the BOJ's hawkish hints are, and also on the Fed's own rate path as well.
Okay. Now, if you're just tuning in, we're in conversation with David Chow, Director of Azure Capital. David, in other news, LVMH is reportedly ramping up its expansion in South Korea, with the luxury conglomerate looking to diversify its global presence as geopolitical and economic uncertainties hurt the consumer spending outlook in the US and also in China. So, according to people familiar with the matter, the group's two largest fashion labels, namely Louis Vuitton and Christian Dior, they're looking to expand their flagship Maison-style stores in Seoul's Cheongdam district within the next few years. How far is North Asia, and if I could add in Southeast Asia, a boon for luxury brands in the near to medium term?
I think this move underlines how luxury groups are diversifying their global footprint as consumer spending in the US and China could be showing signs of strength going forward. So North Asia, I think led by South Korea and Japan, has been a resilient market. In Korea, I think luxury spending per capita is among one of the highest in the world, if not highest, supported by, I think, a young brand-conscious consumer base and the global reach of, K-pop culture. So Japan, meanwhile, continues to benefit from a weaker yen that has, boosted luxury tourism. So together, I think these markets, offer not only scale but also stability at a time when China's luxury demand has been uneven. And speaking of Southeast Asia, it's also emerging as an important growth engine. Countries like Singapore, Thailand, and Vietnam are seeing rapid wealth creation and a growing middle class that aspires to luxury consumption. So while tourist recovery is also adding another leg of support with inbound travelers often spending on luxury goods. For global brands, Southeast Asia do offer the dual benefits of rising domestic demand and the inflows of regional tourism.
Okay. And finally, before we let you go, David, this one weighing on investors for now. The White House Budget Office is telling federal agencies to prepare plans for mass firings during a possible government shutdown. And the move actually would represent a substantial escalation beyond normal shutdown protocols in recent years. Now, basically, under recent years, government workers deemed non-essential in the case of a funding lapse, they were typically furloughed and eventually brought back when funding is restored, usually with back pay provided. So how then would you read into this new development? How concerned are market participants when it comes down to the possible shutdown, though?
I think it may very well be a negotiating tactic to raise the stakes in when you're on budget talks. The threat of outright layoff could be designed to really pressure Congress into avoiding a prolonged impasse. But then again, if such measures were seriously pursued, I think it would signal a much harsher approach that could weigh on federal workforce morale and of course consumer sentiment. But I guess for now, financial markets remain more focused on Fed policy and economic data than on shutdown drama. But the optics of preparing for mass firing highlights the degree of dysfunction in Washington. So if this intensifies, I think it could really rattle sentiment, not because of immediate growth hit, but because it adds another layer of policy uncertainty to an already fragile environment.
Okay, lots to watch indeed, and thanks so much for the insights today, David. That was David Chow, Director of Azure Capital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.